Good evening, ladies and gents. How we doing? Let's let everyone log in, and thank you for joining me on this sunny evening here in England. Don't know what it's like where you are. London's a little bit darker, I believe, a little bit overcast, but up in the northern counties, it's pretty bright. Okay, today I'm just looking at my other screen here. Hope you guys have had a good trading day so far. A little bit of gap up on SPY, a little bit of a gap filled trade, choppy markets, volatility really low at the moment. It's not a webinar about volatility, but just be mindful of getting caught out in the low volatility environments. You know what it's like? You can take a trade, all of a sudden the market can stagnate, and then you're sitting there going, right, what do I do? And you kind of try and force a trade, maybe you get stopped, you take another, you take 2 or 3 trades, and you can end up getting caught out. And at the end of the day, you look back and you go, why was I even involved in that? So don't be afraid to walk away on days like today. I know that that is the absolute separator between, you know, people who have longevity and people who don't, able to walk away, able to just say, no, it's not my type of day. I have one trade idea, execute the trade idea. If it gets stopped, it gets stopped. If it works, it works. A to B type trade, no home run stuff. Come and be around for the next day. All right, so who have we got here? Well, okay, we've got a busy webinar today. You know the disclaimer, guys. Hopefully you can all hear me and see me. You can pump your questions into the chat. What we'll do is we'll do 45 minutes or so, or as long as it takes to kind of cover the topics, and it normally 45 minutes. At the end of it, I will get to your questions. Ask me any question you like. I'll do my very, very best to help you. If I can't, I'll direct you to somewhere that will give you a better answer. But I've been trading for 22 years now, 22 years. So reasonably experienced in the markets. Markets have been reasonably kind to me as well. I sit here and I love the markets as you do. I love trading, and I'm going to share with you some, you know, things and experiences and ideas and knowledge. Hopefully you can take just bits away with you and go, hey, that's helped me out, and hopefully get you a little bit further towards your trading goals. Okay, so let's get stuck into it. A lot of slides to cover. Disclaimer, the risk disclaimer, please understand the risks of trading. Obviously, you guys hopefully know the deal by now, but I still hate to hear the stories of people coming in and are not really understanding the risks and losing money. If you lose money because you're just learning and that's the way it is, then that's fine. You know, that's the progress, and I understand the game we're playing, but I don't like hearing of these horror stories. So make sure you understand the risk involved. Okay, let's also press the right button. Okay, so this is a 3-part webinar, and we're going to do one each week, slightly different cadence to normal. Normally do one every 2 weeks. It's a 3-part webinar, and it's really it's a masterclass, a mini course, we're going to call it. It's a real, you know, I'm going to go advanced here in some deep content, and it's going to take 3 webinars to do this. I didn't want to cram it into one, and I wanted to cover this topic in depth, because if you half touch the topic, it's more deadly, if you know what I mean. You know, you really want the deep knowledge, and the idea of this, guys, is that I want you to go away after these 3 webinars and say, hey, I'm taking that little piece, what I learned in that point of the webinar, and I'm going to implement it. I don't like that so much. I like this. You just pick what works for you, and hopefully then, you know, you can have some skills that you can use in your trading for long term. Like, this is the sort of stuff that really, you know, these sort of tools and skills that I've learned, you know, years and years ago, 15 years ago, 17, maybe not 20 odd years ago. Those are times when you're still kind of finding your feet, but that sort of stuff has helped me through the markets all this time, and it's really this underlying understanding of price action. So, the 3-part webinar series called Price Action Mastery, a deep dive into short-term order flow analysis, and we've split it up into 3. So week 1, we're going to talk about, which is this one, decoding market microstructure. So understanding drivers of price fluctuations, the price versus time sensitivity of market participants, subtle supply and demand imbalances. Then we're going to look at a very specific trading strategy, stop hunting. We're looking for other people's stops to be triggered. We're going to take the other side of those and capitalizing on these liquidity vacuums. Then the next week, so this same time next Tuesday, talk a little bit more about the 15-second chart. I know you're like, oh, 15 seconds, but you know, it's something that you can deploy at certain periods of time, even if you are slightly longer term, just to fine tune that entry. That's all we're trying to do, really. The pace of price, chunking method, that's a really, really good method for kind of reading price action, pulses, pauses, and drives, and then some drills to kind of help you get better at reading short-term price. In the third week, we're going to be talking about some scalping strategies and patterns. So exhaustion fader, this trim and trail technique for momentum, again, using that 15-second chart. Something which I think will get a lot of value if you're kind of a slightly longer term trader, maybe you trade for the whole day or maybe multiple days. If you're a scalper, these swift scalps turn into the steady runners. And then I'm going to give you a tool that I had built. I worked with a coder on this, and I call it Amber, just a random name I came up with. And it's basically a scalping tool that helps you identify certain points in the chart that could be exhaustion. But I'm going to go through that in week 3 in detail, because I want to just give it to you and just you go, oh, this doesn't really work, and because it needs configuring, you need to understand how to tweak and adjust it. So we're going to go through that as well in week 3. Okay, so first week, which is now, decoding market microstructure. So before I get into this, I just want to talk a little bit, very, very briefly, about this whole concept of tape, right? Tape. So tape reading it's been hijacked a bit recently in people look at it at level 2, the market depth, the dome, that kind of thing. If you think about back to everyone's reminiscence of a stock operator, absolutely recommend it if you haven't. Jesse Livermore days, he would have, and I've got it in my office, no, it's in another office, the tape reading machine, and the price would come through. And that's what it would call tape reading. So you'd see price, and it was the interpretation of price, the speed, the price change that was actually reading tape. So in a way, what we're going to do today is talk about how to interpret this price change, this price movement. So we're really kind of digging in to seeing price changing 58, 59, 58, 58, 9, 60, 60s back, and really understanding what that means. But first of all, we need to start with the understanding the concept of price. And I know this sounds basic, but how many times have you sat down and really thought, hey, what is price? How does it happen? How does it move? What does it trade? And what's the volume on each side trade? What's the transaction mean? Because understanding this, spending a little bit of time here, really gives us the foundation to go, okay, so when we deploy some of these very short-term scalping strategies or other types of strategy, we know what we're actually doing. Because I don't know about you, but for me, I like to think, okay, why is someone else going to buy after me? Why am I going to make money on this trade? What's the reason behind it? There's not a macro reason. It's a justification of why price should change urgently now. Why now, right? Because without that, we've no edge, right? You're a short-term trader. I'm a short-term trader. Our operating strategy is to come in and to find short-term inefficiencies in the market and take advantage of those. And we go in with that expectation. We have our risk managed if it doesn't work out, and we try to exploit and take advantage of these short-term price movements. Whether short-term for you means a minute, whether short-term for you means over the day, whether it's multiple days. We're trying to find the inefficiency and take advantage of it. We're not guessing. We're trying to use what's called edge and cultivate edge. So let's skipping slides here. Understanding supply and demand. So think about why a person buys. They buy because they think the market will go up, right? They are hoping that someone else will buy the market after they have bought, causing it to rise. Now, slight caveat here, which is important to remember. I want you to hold this in your mind for the second. Some people also buy because they're scared of losing more money, or they are under some other pressure, and that's why they have to buy. They're not buying because they think the market's going up. They're buying because they don't want to lose any more money, or they say institutional broker and they say, get the order done now. There's a real sensitivity for time. I want to do it now. And just hold that thought for a second, because there's two sides of the coin here. If you think about the supply demand shift, if you imagine price going up, the more supply we have coming in, less demand, then price is going to go lower. The more demand coming in, supply, price is going to go higher. But I also want you to think about this. When you've got huge supply and huge demand, what happens with price? It doesn't go anywhere. You have those two big arrows pressing and price just stays where it is. you've got thousands and thousands of contracts being done, traded, shares, whatever, and price not moving. It's when you have that supply demand, one of them backing off, that we start to see price move. Okay, so under the bonnet, I know many of you trade CFDs and spread bet, and you don't need access to this, but just understanding what is actually happening under the bonnet, so to speak, and really appreciating, why price and transaction is occurring, and thinking, okay, listen, I've got people stacked up on the buy side, stacked up on the sell side, and those of you who've seen like a price ladder before will see this, and we are ultimately matching orders. That's what's happening. Price is kind of matching an order. Someone's saying, hey, I want to buy, but I don't want to wait. I want to just buy now. And so in this case, they'd be buying at 34,851. Bang, that would be the price to be filled at. That's our bid and offer, right? If you're trading CFD or spread bet, you just have to take the offer. You have to lift the offer, or you have to hit the bid, and that's the price you're paying. People who are transacting directly into the market have the same decision. They either go, hey, do I wait and wait for price to come to me, so I'm more sensitive on price, or do I need to get in now? And this is the key. This is where we get our edge. When someone is more time sensitive than price sensitive, that's when the market moves. If you get an order now to come in and say, right, I need you to buy 1,000 contracts in this market right this second, that's time sensitivity. Don't care what price is. That's what moves the market. You come in, you be like, bang, 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 buy, 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 buy. That would change, obviously, the price of the underlying. That would change our CFD product, our spread bet product, whatever you're trading, and that's going to cause price to move. Versus someone who comes in and says, you know what, I need to get this order done, but I'm not going to pay more than 38,830, for example, right? Or 34,830 in there if you've got using this price up here. So like, okay, price comes down a bit, buy a bit. There's much less movement and much less reason for price to move. So time sensitivity, price sensitivity. So our job as a trader is to really recognize when people are absolutely time sensitive. That's when we get this exhaustion stuff we're going to talk about in a moment. We get to that strategy of kind of spotting those stops. And you think about when you have a stop loss, right? The stop loss says, most of the time if you use a stop market order, I don't care what price it is, I want out. I just want out. I want to stop the loss. That's the order. That's the point of the order, a stop loss order. So, and very often people complain and go, oh, I'm getting stop hunted. You're not getting stop hunted. You're just placing the stops in a place where everyone else has got them. And everyone else at that point in time is time sensitive. They need to get out now. The order goes in as a market order and gets filled whatever price. And of course, that's going to hunt for liquidity. That's going to kind of suck liquidity out of the market when you look under the bonnet. And of course, very often we get that pop back up because it's going to rush down quickly. You're going to sell, hitting those bids. It's going to leave a bit of a liquidity vacuum, and then price is going to pop back up. How many times have you seen that? The price has come to a level, rush through it. You see a big wick on your candlestick chart, shoom, pops back up. And next thing is it carries on the next sequence. Now, sometimes it does continue, and you might get a little bit of stagnation before it rolls back over. But that short-term period there, which is what we're going to focus on in a moment, it's very, very important, and it really is highlighting what's going on under the bonnet. Okay, so just stay with me for a second on this before we kind of move on too much. Think about what causes price to move, right? Every buyer must have a seller, and that's a key thing to think about. People often come and go, oh, there's more buyers than sellers. That's not true. That's not true. If the market goes up, there's got to be a transaction taking place. Someone has got to bid 58. Someone's got to buy at 59, 60, 61, 62, 63. There's also got to be someone to sell them to that stock or that futures contract or whatever it is for price to print at that level. Otherwise, there's no print, right? That's how price is printed. So the key question to ask yourself is, when you're trading this, is which side is more aggressive? Which side is time sensitive? Which side doesn't care what price they pay and are prepared to give up a little bit of price because they want it now? Because those are the market orders, and those are the orders that move price. So, not getting ahead of myself too much, but I think it's important to add this in here now and have you thinking about this concept. Where on the chart are people time sensitive? Where do they need to execute immediately? Because that's the edge for us. When people need to execute immediately, that's the edge. That's where we kind of find those opportunities, and we're going to talk about that exhaustion stop punting play in a moment. But have that thought in your mind: which side is more aggressive? And very often when you look at a chart, you've got these patterns and stuff that you go through, and that's fine. Whatever you need to use to carve your edge out. But just the extra little thought, if you don't take anything away today other than, okay, which side is more aggressive and where would they be more aggressive? thinking about trend days, range bound days, rotations around the VWAP, the opening print, prior high low, these type of things are why levels work, because that's when one side is more aggressive than the other. And ultimately all we're seeing is this supply demand imbalance on the chart. So if we look at a few kind of chart examples, right? This is bog standard DAX chart, German 40 is Pepperstone's product. 8 o'clock is the UK time when everything kind of opens up. This underlying stock exchange opens. What have we got here? Just a very steady, lots of kind of back and forth, slow supply is a little bit more aggressive than demand. There's demand there still, of course, because we're getting the print, and it's not massive movement here. We're talking 80 points movement on the DAX, not a lot, but it's just that steady. Supply is just hitting those bids, and it's just settling. Maybe it's popping up a little bit, and you see those kind of pops, but ultimately, it's just ground lower. So there's not much sensitivity there. There's not much sort of urgency. It's chugging, it's fine, but at that point, it's not real much urgency. And then even less so here, we've got a range bound environment. It's paying out to the higher of the range, it's paying to the lower of the range, it's back and forth. Eventually, it breaks up, but not with that much conviction. It's an equilibrium. If you go back to that kind of seesaw analogy, you've got supply demand reasonably balanced. It's kind of going up a little bit, coming down a little bit. Who's urgent? Why would someone want to buy after you've bought? Why would that happen? Okay, you can trade the ranges and stuff, and that's maybe something to explore. But is that really big edge? Is that something that's really gonna get your teeth stuck into? Not really. So but then you kind of look at some of these bigger, more aggressive moves. Like this is a big swing up within an hour, big swing up on the US 100 and Pepperstone's Nasdaq equivalent, and a big dive lower, and then a big spike coming into, I think this was the end of the month actually. No, it wasn't the end of the month. It was I think it was a very, very key trade. It might have been, thinking about this, whether it was an options expiry. It was something key which caused that last spike. But the point is that there's urgency, and what I wanted to point out was the difference. And I know it seems obvious. I understand range bound, but look, just think again through the lens of that question. What's the sensitivity? There's real time sensitivity here that people need to get done. They've got 5 minutes left to get all their orders done in the underlying market, and it needs to be done quickly. That is a real good example of time sensitivity. I need to get done. I don't care what price. I don't care if I've paid 13, 140, 50, 60, 70, 80, or didn't quite get to 90, but I want in. Our edge comes. I'm not saying we capitalize always on this, but in the right environment, the right structure, that's where our edge comes in. Our edge comes in when we're reading when people are time sensitive, because these institutions don't give a about small movements, but we do. So if we can spot when they don't care and they're all throwing money away, and they're like, hey, I don't care, I want to get filled, and we can spot that, and we can preempt that, and we can get in place of that. That's how we can capitalize. And that, ultimately, guys, we are a small fish in a big pond. But the good news is, imagine a huge pool. We can kind of keep our little corner. We've got our wall there, and we can just be an expert in that little area. We can let all the sharks swim around and do this. But there's enough opportunity in this little area to be able to capitalize. A wave comes in, we grab it. There's some fish coming, we grab it. And so, just understanding what we're trying to do. We're not trying to compete. We're not trying to be heroes. We're just trying to capitalize on these short-term price inefficiencies. All right, so example here, same type of thing. Urgency. Just after the open, this is the Dow. A little pause and bang. Completely different scenario. And there's a real urgency there. Okay, so let's just think: why do market players decide to buy? Yeah, we're not talking about macro here or anything like that. There's excellent experts out there who are far more versed on that and understanding how the money flows around on kind of longer time frames. But think about this. From a short-term perspective, why do they suddenly go, geez, I need to buy? Economic data, interest rate announcements, especially at the moment, jobs report, CPI, some manufacturing data coming out, ISM, daily, weekly, monthly stuff that comes out and changes. And that's why bigger players decide to buy. Now, that could linger. You could have that impulsive move now, and CPI at the moment, obviously CPI, the inflation number, are causing people to consider buying long term, and that immediate effect as well. Then you've got earnings as well for stocks, the quarterly earnings, interim reports, any management news, and then breaking news, forced hands, unexpected world changing events. We have Brexit, terrorism, deaths, technology. All this stuff is why are people deciding to buy? And just remembering that the people are buying for a reason, right? They're not buying because it's head and shoulders. They're buying, or inverse head and shoulders. They're buying because they feel like that's where the money flow is. Okay, so market players and participants, just a final point on this. We know for every buyer, there's got to be a seller, right? We know this. And if you think about the players who are involved, banks are involved, hedge funds, pensions, mutual funds. Then we've got the small guys, small trading firms, independent traders. And if you're trading a CFD or spread bet product, you've got the broker who's hedging off some exposure when they get too much on either side. So these are the retail players, institutional players. And understanding what the market is doing and why, and maybe the players and participants behind it can give us a little bit of an insight into what might happen with price. Think about a big trend day, that's just institutions just selling systematically, not retail traders doing that. Retail traders are often failing that and getting caught, and they might be exaggerating some of the stop loss type stuff. But think about, hey, when you get like a little ping through a level that pops back, that's probably a lot of retail traders getting stopped. Maybe it's a lot of liquidity hunting algos out there. It's not big banks making big movements because they're not doing anything. They don't care about that. So just again, understanding who's driving the markets and what's driving the markets. I talked a little bit about algos, and going back to the initial query in the mind that should be in your mind for any trade is why is someone going to buy after I bought? Why is someone going to sell after I've sold? The market participants and their objectives, right? Short-term algos, we've got predatory algos, HFT algos, arbitrary trading algos. I don't want to go into depth of algos here, kind of is something I cover quite a lot in other things, but understanding those are big. Institutional flow, they're trying to conceal those size orders, but at some point they're time sensitive, like we saw in those charts. At the end of the day, they need to get order done. If you say you're an oil broker, right? You're an oil broker, phone rings, you've got 5 minutes left until the option shut on that crude oil, or you're trying to trade a crude oil ETF before the bell goes. And yes, there's some aftermarket stuff, but maybe there's not enough volume. And some big guy comes in and says, oh, I need to, do this massive clip. You've got to get it done. There's time sensitivity. Retail flow, that small order flow, hedging, people having a prearranged level they need to hedge at, whether it's hedging off some sort of options exposure, market makers playing a game. And by the way, talking about market makers, I do a daily email at tradersmastermind.com, top right, daily email. And one of the emails I sent out was, I used to listen to pit audio. It was many years ago, listen to the pit audio. And the traders in the pit, the locals in the pit were kind of making a market. And very often they would kind of, do very well after making a market. But the time when the opportunity came for me and came for kind of screen-based traders was when they were stuck and they had to get out of that position. They had to get out of it. And actually, I talked about a story about number one local. Go and check that out. That email's available. I think I've got on the website. I'm not sure. But the point is that market makers are there back and forth, but also they sometimes are time sensitive. Stop losses, profit taking, etc. Okay, so let's get to this edge quickly. The mini exhaustion that we often get, right? This is an edge that appears. Well, I believe it's an edge. And, do your own research, of course. I'm not telling you to do something, absolutely not. I just hopefully give you, inspiration to go and look at a light bulb and you go, okay, I'm going to explore that, Mark. I quite like the idea of that. This is an edge that appears from other participants' time sensitivity. Think about that again. The time sensitivity of a stop loss order. I need to get out of this position now. I don't care what price. I need to stop my loss. It's a motive, right? It's the way the order is structured. And as retail traders, we become very focused on this short-term quick opportunity because I believe it is an opportunity. Now, listen, we're going to go through some structure to this and how to structure it, but I do want to have a caveat of, hey, if you, and mindset's a big thing in trading, psychology, having the right self-control and discipline. If you struggle with that aspect, if it's a struggle for you, the discipline side of things, then this is probably not something to explore yet. Mothball it, say, hey, when I've got my discipline dialed in, because this is quick, you need to have a quick decision making, you need to be on the ball and out of that trade damn quick if it doesn't work. So you're not one of those people who stuck a deer in headlights, market's going against you. It's that quick decision making, in, out, yes, I'm right, yes, no, I'm wrong. But if you don't have that discipline dialed in, then, by all means, learn from this. but say, hey, I need to work on my discipline first. I need my mindset dialed in. I can't be operating on this shooting from the hip and hoping things work, breaking rules and all that nonsense. I need to have myself absolutely dialed in, on point, ready to perform, and then you can kind of explore this type of thing. So just a little caveat there. All right, so think about stop losses. We'll look at charts in a second. I think the next slide. They cause that sudden rush in price, right? We get that boom, rush in price because time sensitivity. I need out now, now. And think about when we get a lot of stop losses, we get that boom, big shudder. Now, we don't always get these massive amount of stop losses coming in, but we very often get them. And you know where you get them, guys. You watch charts just like I do. Prior lows, prior highs, weekly lows, intraday lows on a big trend day. Big trend day comes down lower, unwinds, everyone thinks it's going high, everyone piles in long, creaks back over right to the low. There's about 15 minutes left. You bet there's bang a load of stop losses there, again absolutely smashed. You get a sudden spike in volume, and it's this quick scalp we're going to look at for the well prepared. Now, this is also very key, I believe, is being prepared for these. We don't want to be sitting there just waiting and just getting bored and taking substandard trades and all that rubbish. No. We want to be, dialed in, prepared, looking for the opportunities, know where they're going to come, when they're going to come. Does it come? No. Okay. Does it come? Yes. Ready in and playing that game, being very, really on point with the way you execute. Thinner markets, they're more exaggerated. Obviously, it makes sense if we go back under the bonnet, when we're looking under the bonnet and we're seeing all the structure behind the bid and the offers. Of course, the thinner market's going to be more exaggerated. If you just smashed a 500 lot into that bid, you're going to get a big spike down in stop. You stick 500 lots in the S&P, it's hardly going to blink. So thicker markets is more exaggerated. And think why this occurs again, right? And I picked just a few rough examples here. Natural gas, this was a while ago. This had that big spike up before it resumed its downtrend. But just look, this was that big rally. So it's a motive. It's already been down. Natural gas has been hammered massively. If you're not looking at natural gas, fine. Don't blame you. Plenty of other markets out there. But they've been hammered. Had this kind of bit of a rally, up 7% pop. The next day, it gaps lower and it starts to trade through the prior low. Now, that's a motive, because a lot of people have been sucked in buying this, thinking, here we go, a big reversal. And of course, a lot of people's stops are going to be under here. And so we see, bang, big spike in volume, big spike in price range. We're going to dig into those in a moment. So I'm not going to gloss over those. I promise you I'm going to dig into them because that's where their edge is. But just the concept of, hey, we see this quite a lot and very, very recently. And another one here, we've got on the 1 minute chart. How did it look in the 1 minute chart? Spike lower. We've got same thing we have on Bank of America, same type of thing, counter trend move, bit of a spike in volume. I'm going to kind of glance over these because I want to dig into stuff a bit more focused in a second. But you get the concept of stop. You've traded on the chart, man. You've seen stop losses being triggered. I probably didn't need to include those, but if you haven't, then they're there. You see what they look like, right? So let's look at this stop loss hunter strategy and caveats, of course. Do your own research in this. Decide if it fits for you. Decide if it doesn't fit for you. I'm absolutely not telling you to do something that works for me, may not work for you, works for certain times. And again, I don't want to bang the same drum, but please, if you have the discipline thing, that needs to be dialed in, because this is just going to put you on tilt if you're not ready for it. But if you're ready for it, you feel disciplined, then explore, have a little explore. Because, as you think about, we'll go back to the point of the logic of this. Why does this work? Because people are time sensitive, and you're like, hey, by all means, you need to get out now. That's fine. Out you get. I'll come in because I'm prepared. I'm ready. I'm on point. I'm ready to execute. When all those people who have to get out now, that's fine. Out you get. Last one out. Thank you very much. In. Let's wait for that pop. We'll get into the concepts in a second. So choose a market. This is kind of the broad strategy. Avoid those big high vol markets. You can trade like the big fat S&Ps and some of the interest rate stuff, but just choose something a little bit thinner. DAX, and thin. DAX isn't stupidly thin, but we're not talking about cotton here. But something that's just big market. You want something that's medium. Like the Dow, I'd call that DAX, FTSE, natural gas, maybe crude. You just don't want. I would personally avoid really thick, the biggest markets like the S&P or the interest rate futures. Anyway, and you can also do it on On some of the currency pairs, we'll look at some currency pairs in a moment. Not quite as pronounced, but still there, still valid. And we've got a slight problem with how we judge that, which we'll see in a moment. So take a step back, right? We've got a market. Let's say we pick Dow. Let's say we pick DAX. DAX is a great example. DAX is good for this. You take a step back and ask yourself the question. Say, hey, where could stops be triggered here? Is it prior high? Is it prior low? Is it above a VWAP? If you like trading the VWAP, where could they be triggered? And again, use your little bit, your knowledge and however long you've been trading, and say, because you know how this game works. Where could they be triggered? Could it be counter trend pops above a key level? And I'll talk about those days when we get those big downtrend days, and they kind of they range at the bottom, don't they? And then it kind of pops above it. Everyone goes, off we go, we're going reversing, and it goes, oh no. And it's just pinging out those people. Is it trend flushes when we have a trend day? Now these are ones that you can. You're not looking for the home run. Is what I'm trying to say. You're not looking for the home run when you see these little flushes because it's a downtrend, heavy downtrend. But you can get a little mean reversion, a little pop back up, done. Wait for the next one, pop back up. Obviously if you're short from the open, that's a much better trade. But if you're not, and you're kind of trying to scalp these little flushes, then if you've got them below the key level flushing, and again we're going to talk about we're really strict with the risk management, so you're not caught on it. You wait for the pause and then you go. But yeah, we'll put the exact methodology in a second. So we have the market, we have the levels we're looking at, prior highs, all the levels that I don't want to go over basic stuff that and now we have the patience. And what we're waiting for are three things for the stop loss hunter. We want a wide bar, so a good range bar. What that is, high and low is quite a good range. So relative to the rest of it, it's good, it's strong, it's wide. And if you want to put an ATR and a 1 period on, you can do that. I think I've got a chart for that in a moment. Large volume and a key level break is absolutely preferable. Some people say, oh, you can do it anywhere. I'd like to see a key level break because I want to, again, let's go right back to the beginning. The reason people are executing, the reason is because that's a level that's a line in the sand for people, whatever. We saw that, we see it all the time, sort of natural gas, sort of DAX. That's a key level. People are like, oh, I'm not going to stop there. And then we confirm it stopped with large volume. We confirm it stops with a wide bar because we imagine all those orders coming in. They've got the time sensitivity. I need out now, need out. Brrr, we hit that cascade on the order book. That causes that wide bar. That's what we're looking for. And this comment here, the road is littered with impatient scalpers. And it's so true. If you are a scalper, or if, let's say scalping plays a part in your trading business. Okay, so you've got scalping, maybe you've got some intraday stuff, maybe you've got other bits. You don't have to just go say, right, I'm a scalper and that's it. It could be something that you add and say, in the right conditions, I do this. And in the right conditions, I do this. We're just looking for opportunity, right? We're traders. You don't have to kind of wear a t-shirt that says, I only scalp. But if you do, that's fine. But just remember that impatient scalpers are just, you're just fodder. You're just fodder. If you're going in and scalping when the opportunity is not there, you're just trading on a coin toss. Even worse, because you know that it puts you on tilt. It has all those kind of propensity to trade with emotion and all this kind of stuff. So really, just thinking carefully about this. All right, so patience. And at the end of the day, guys, patience is there for everything, whatever you're trading, but absolutely it is for short-term traders. And going back to that book, Reminiscences of a Stock Operator, by Edwin Lefeur, I think. But it's about Jesse Livermore anyway. Amount of times in there, and some of the quotes that you remember, I remember that I must have read it a dozen times, maybe not a dozen, 10, I'd say. The patience. And in the interview here with traders, patience, both waiting for the trade and when you're in the trade. So, just remember, don't be impatient. Don't be another one of those people who just gives up all his edge and gives up trades all his bullets before we even see your opportunity. So we're back to stop loss hunting. So we set up our chart. We want volume on our chart. And I like to use an ATR 1. Now that's really intraday. That's going to give you just a range of the bar. ATR is average true range. Generally, people have it set to 14, and it shows you the kind of range, the average range of the market. Now, if you're using a daily chart, it kind of treats gaps a little bit differently. But if you're using it on a 1-minute chart, it's fine. You can use an ATR 1 setting. And I'm using this because I know that everyone's got ATR available on their chart. So it's going to give us the volume. And this is going to give us the range of the bar, those two of the three criteria. The third criteria is the higher time frame analysis. Do your top down stuff, your 15-minute, your daily if you need to, maybe a bit higher, but anywhere you need to go, right, to see the levels, the key levels, the prior day low, prior day high, always a big level, current day low, current day high, weekly low, weekly high, VWAP, any of these type of things. And one thing, if you're a stop loss hunter, don't be the guy who sets the alert at the level. It's too late. So if you sort of say, hey, listen, it's right in the middle of the range. There's no stop losses getting triggered here. I'm a stop loss hunter. I'm waiting to see those falls who are coming out with time sensitivity. Where's that going to be? You go through the process, prior high, prior low, right? Set your levels, but set alerts. A little tip is to set alerts a little bit before so that your attention is drawn. Even if you're at the screen or if you're not, you don't want to be attention to be drawn as it's hitting the level. You should be already ready and watching that thing, but that's sloppy. You want to be there ready so that you're at the screen. Alert is 25 ticks, say, or however much the calibrated for ATR on the day. So you want to be there. Ding, alert goes off, right, it needs to be prepared. Okay, right, it's coming to the level. We're not there yet, but it's coming to the level. We said, relax, get my ticket set up, get everything prepared and ready. You can't be flustered and coming in going, oh my God, it's at the level. I'm going to make an impulsive decision. No. That's not how we're reading the price action short-term order flow. We want to give ourselves a chance to read the order flow. And the point is such a high cognitive load. We're not doing it all the time. So we set those alerts, come in, ding, goes off, right. Now you watch price. How does price move? How does it change? And next week, we're going to talk a little bit more about how we really interpret that price change, the speed of the change, how it's kind of moving 58, 76, back to 7, 6s, 6, 6, 6, print 7, and watching that little nuance that right at the moment, that's where we're going to time it. But for now, we're trying to put a big structure and we'll have the volume, get your ATR. And if you get your alerts, make sure you set them early. Little tip on that. Okay, so this would be how you set it up. Your volume, TradingView, by the way, volume, ATR set to 1. You can see, the range of the bar is here, and here's our volume here. Now, one thing to point out, I've done it again on the US 500 S&P equivalent. So one thing to point out, I know many of you trade a CFD product or spread bet product, Pepperstone. The volume you use on TradingView is an approximate volume. There's nothing wrong with it. However, if you want the true volume, you're going to have to get the volume from, let's say, the ETF, right? So if you're trading the S&P 500, US 500, it's a reasonable approximation. It's absolutely fine. But if you want to go more granular, then getting SPY, which is the ETF of the S&P 500, so the actual exchange, and looking at that volume. Now, you're still going to trade the product, this Pepperstone's product, fine, absolutely fine. Take the advantages of that and the low commissions and all the other reasons to trade that way. But setting up your charts and maybe just having a little sub chart that has the volume for the underlying asset. And SPY is fine, off using ES futures, that's fine. But you can see how there's a slight difference. We still get, there's a difference there's a volume spike here, but the volume spike occurs and it's much more pronounced. And so when you're trading these kind of flushes and you go, okay, this is stop loss hunter, maybe it's a short-term low here, and not the greatest example, but example for range and volume it is, big spike in volume, biggest range of the day, often that's we're going to get a little pulse off there. But notice the difference between that and the broader volume. It's okay, but just something to think about if you're setting up your charts and you want to be really dialed in on this. Okay, so that's the process. Let's do the process. Why a stop's going to be triggered? Don't forget the level key. What's the level? What does it mean to people? And think about you getting caught out by this. This is the way I like to do it sometimes. Like, hey, go back to beginner you who puts his stops in the most obvious places. Oh, well, I'll just put it above the high. I'll just put it below the low. And in certain conditions, absolutely. Momentum condition, fine. But that's when they get tested, they get pinged. So why is a stop going to be triggered? And that's going to be, okay, someone believes the market's going to go higher, back to the second slide or whatever we were, fine. They probably think that that's wrong if it goes below the prior day's low. Okay, great. Just like a natural gas example, that would be where the stop will be triggered. And it will be triggered because people were thinking this is a short-term trend change. And if it's not, they're going to get stopped out. And don't forget, this seems crazy, but we're preparing a lot here for a 1 minute movement, 15-second movement, 30-second, 2 minute, 5 minute. Maybe we'll turn it into a longer trade. We'll look at that in week 3. But with a lot of preparation, but that's what it needs. That's what it requires. This game. It's tough, right? It's tough. But if you prepare and others don't, who's going to win? It's the way it is. you were prepared and you're ready and you're dialed in for this. This is how it's going to benefit you. So why will stops be triggered? That's your levels. When is it going to occur? And this is, thinking a little bit strategically, using your experience to say, hey, at the open, maybe if you're trading currency pairs, the open of an Asian session, the open of US session, or when do we get these kind of extensions? If you trade the indices, you know that very often we get these extensions coming into kind of 4:30, 5:00, 6 o'clock time, UK time, because Europe closes at 4:30. You get a little extension, you used to call it noon balloon, spikes people out and reverses back. So just dialing in a little bit about the time of day, you might get that the open, the close, and sometimes you get those counter trend spikes in sort of the lunchtime area. But you kind of know this if you're experienced in the market, yourself. We'll go through that at some point. And where on the chart is it going to occur, right? So now you're prepared. Now you're prepared. So you've got your levels, right? Now what next? So as the price approaches, you reinforce exactly what you're looking for. And I've put this in bold because this is important. We don't want to get sidetracked. And just like a recent email I did, actually podcast episode I did recently on Traders Mastermind podcast, I talked about the sirens, the Odysseus strapping himself to the mast. You guys remember that story? We don't want to be that trader who gets sucked into, I'm seduced by short term. I'll just take a little short here while I'm waiting for the long. No. Come on. You're waiting for the long at lows. You want those stop losses to be triggered. I want to see this big range bar. I want to see this volume. I want to see this. And we'll talk about how to really fine tune it next week with the 15-second chart. I want to see this. Reinforce it in your brain. I'm not going to be deviating. I'm not going to change. It's exactly what I'm looking for. I'm prepared for this. If it occurs, great. I'm going to pull the trigger. If it doesn't, fine. I'm going to move on. Break of the level. I want to see a break of that key level. I want to see stops being triggered. I want to see a large extension. I want to see big volume. Those are three things. Then the pause, and again, we'll look at the nuances of that pause and chunking and all this other stuff. Methods going to help you time this better. But for now, the pause, the flush through, it works, right? The flush through hits the level, boom, flushes through. There's that little pause, just that little pause. Like the whole world seems to stop. It doesn't. We're traders. It's not only the market that seems to stop, but it does when you're trading. You're looking at that damn short-term chart, right? The whole world seems to stop. It's there. And there's your trigger. You're like, right, that's my stop losses have been triggered. Volumes come in. Yes, check. I've got my risk capped. I know my risk management. There's no reason not to execute that trade. There's no reason not, as long as it's the strategy you're happy to deploy and you understand the risk with it, of course, right? But reinforcing exactly what you're looking for. And even if this isn't your thing, even if you're like, stop loss, I'm a bit of a high time frame, reinforcing exactly what you're looking for is such a superpower as a trader to constantly be, subconscious is there going, what does he want? What does he want? Does he want to go long? Does he go short? He wants to make money. I should go in now. No, just reinforce. Hey, I'm waiting for this level to be tested. I'm waiting for a pullback here. I'm waiting for the flag to break. I'm waiting for us to retest the prior high, fail, double top, wick through, come back, whatever that is. I'm going off piste a little bit here, but reinforcing exactly what you're looking for is something that will absolutely help you, whatever strategy you deploy. So not getting sidetracked, not being dashed on the rocks because you see something really attractive and seductive. Oh, that looks nice. I like that little momentum bar. Oh, I'll take that. Bang, you get smashed, you get knocked out of the game, you hit your daily risk. Worse, you overdo your daily risk, you go up till you end up doing damage. No, stay focused on what you're trying to achieve in the day. In this case, we're a stop loss hunter. So, example, I've used Qs because I want to show you the volume spike, but it's a great kind of miniature example. And you might be like, it's so small, but being prepared for it, this is all right. On a pretty averagey, crappy day, this is actually something that if you're ready for it and you drew these levels in, there's my low, there's my high. Okay, I really want to see a big volume bar. I want to see a big price extension. Okay, and then we'll fine tune it in the next week, but I'm waiting for that level. But at least you're in the right zone, right? Just doing the work to get you in the right friggin' zone, my level. Now I see the extension. Now I see this. And if it just chugs through, by the way, well, let's not always do that. Then you're not going to get the spike in volume. You're not going to get the spike in range in price. It's just going to go jing through. And if it does and it continues, and that's why we have a stop loss. But if you're there and you're trying to time it, very often you've got high probability, chance that you get pop up. And again, then it's up to you to manage it. We'll talk about the trim and trail technique later on. But just getting that lever, just getting the edge in and saying, I'm a stop loss hunter. That's what I do. I take advantage of people's stop losses. That's it. And then you're very, very calm, collected, methodical, and you're like a sniper. You're not sitting there just cracking off rounds whenever you feel like it. You're waiting for the specific thing you want to see and accepting you're going to miss it. You're going to miss it. You're going to miss it. But all you've got to do is get on one. And risk reward's good. Probability is good. Bang, I'm in. And trading that way. So yeah, this is the example actually I wanted to just point out again with the volume there on the Qs, which is the ECF of the NASDAQ. If you use the other kind of CFD version, you've got to be careful you're not getting confused by volume. So it's worth having that on there as well. Pepperstone's DAX product showing you that it's not just range bound conditions. Now you might, admittedly, you might say, hey, I don't want to be involved in this. I'll only trade short stops on a downtrend. And what I mean by that is what I said kind of early on, where you get that downtrend and then it kind of sometimes just sits there in a range and it pops up out of the range, comes back in. You might say, I only want to trade that. I understand that and I'd accept that. I think that's fine. But you also might say, hey, I'm not going to blindly try and catch a falling knife here. We're obviously in a downtrend. It's reasonably steep. It looks like it could continue, and this is important as well. Everyone says get on the downtrend, but sell the pullback, so let's do that. If you're the type of person who struggles to do that, that's okay. Work on it. Work on being able to kind of sell these pops. Work on being able to sell pullbacks to moving averages, because that's where the bigger meat is. But if you have a propensity to trade counter trend, you like trading counter trend, you like catching those. And don't forget, years ago, Paul Tudor Jones' quote was, I'm just not very good at trading with the trend. I like to trade counter trend. I like to catch that top 10%, bottom 10%, I'm gone. Right? And I think it's Paul Tudor. I'm almost certain it was. Don't quote me on that. Someone can double check that. But the point was that really resonated with me. It's like, hell yeah. This guy's seriously winning, and he's not going with doing what the crowd are doing. And great, if you can catch the trend, absolutely. But if you're a person who likes to trade counter trend, you can just sit there and go, hey, do you know what? I'm going to look for these spikes lower, and when I get a big extension, when I get stuff, I'm going to take the trade. And it works or you're out. We're going to talk more about risk management next week to really dial that in, because you don't want to be caught in it. But the point is, if you see that extension, you see the right thing, jump the gun a bit, then you're waiting just for that. And then you don't feel so bad if you're in a trade and it's trending and trending and trending and trending. You're like, hey, I don't want to get on this trend. I don't really want to have us catch a falling knife and start adding to the position, doing all this other stuff. Okay, I can become a stop hunter. I can look for people who are trying to catch a falling knife. They sit with it until they can't take any more pain. They vomit out the position. You didn't need to see me do the actions there. They vomit out the position. You know the score. You want to be the person who's catching that little pop back up, in, out, done. Next. Wait, sniper. You're waiting, in next. That's the game. It's very different to another type of trading, but it's something that, again, patience. If you're impatient, you may as well just give your money away if you're impatient. You have to be patient, waiting for your price level, your extensions, both the volume and in range. So next session, we'll talk about 15-second chart. I'm going to really dig into price pace, because price pace is going to help you pinpoint this. Because the little hole in this, you're going, the jigsaw's fitting, Mark, but what about when do I go? Do I go here? Do I go there? Do I wait for the bar to close? So price pace is going to help you spot that. Of course, it's not holy grail. Of course, it's not a silver bullet, but it's going to help when you see that price pace, and then pause, one more little kiss, and then roll back. That's little sweet spot is where you want it. We'll go dig into that. And the change of pace, time your trades, chunking method, I loved it. I learned this years ago, and it's really good method of kind of bracketing these short-term price moves, seeing price and visualizing in your brain and mind kind of how you create a little, I don't want to kind of go into it now, but you create a little chunk and a little bracket for price, and you see how price, it stops you getting kind of caught up in the chop. Very short-term bracket, you move the bracket. We'll go into it in more detail anyway next week. The subtle price patterns like the pulses and pauses, and some drills that improve that short-term feel, because you can't just, if you sit here and try and read all the time, you're just going to burn out, and of course you're going to get impatient. You're going to pull the trigger when you don't want to. So we wait for those opportunities, and just drills you can do. So even if you don't want to try and trade this live as such now, It's just some things you can do to improve that kind of short-term order flow read. All right, so I'll take some questions, guys. You can find me at tradersmastermind.com. Do sign up for my free daily email. It's a 3-minute read, insight of the day, resource of the day. People are loving it, and I really appreciate the feedback on that, and I really enjoy writing it. So let me go to the questions. If we have questions, how long have we got? We've got some time for questions, and I will have a look and see what we've got. All right, some coming in. Thank you very much, ladies and gents. Let me just, I'm looking at the other screen, by the way. I'm not avoiding eye contact. I am scanning through these. These aren't, it's not a very big window, this, but let's see how we go. All right. Derek says, how to guide against institutional liquidity gaps. Let me move this over here. Better. How to guide against institutional liquidity gaps. Okay, so Derek, you mean, I guess you mean, okay, if you get to a level, how does price is moving kind of aggressively, there's no liquidity there. And what I think your meaning is, when you're in the order book, you don't have those levels we looked at when under the bonnet slide, when they aren't filled with orders, then the price can gap. Now, very often that normally occurs more when they're coming up to data, right? Data, the order book goes thin because no one wants to be caught out. No one wants to be making a market near the current national best bid offer. No one wants to be making a market there and get caught out. People might be having wide offers and bids in to try and catch that little spike. That's another strategy. But when we get to kind of data, there is liquidity gets sucked out of the market. Just avoid those times to trade, or be very, very careful about where you're doing it. But really what I want to say, Derek, is we're using that to our advantage, because as price goes through the stop, you get the big volume. Think about the volume and think about going back to the early slides where we're hitting bids and every seller's got to be a buyer. Take the buyer out, take the buyer out, take the buyer out, take the buyer out, because those time-sensitive sellers, that leaves a big liquidity gap that we take advantage of, especially if we're trading a CFD product or spread bet product, because we can then trade at that low, get that pop back up and get that little short-term extension. Thank you, Derek. Kathy's asked the question, will we get a recording? Yes, you will. It will be delivered to you. If you register for the webinar, absolutely will be there. I'm not sure whether it comes after. It comes, I think, within 24 hours or so, gets processed and stuff. Daniel says, hello, Mark. Thank you for this series. And he also says, by the way, liking the beard. Yes, the big elephant in the room. If you guys have seen before, this is my beard. As an Easter beard, I'm calling it. The first time, you believe it, that I've actually grown a beard. I thought, you know what? I will try it. And if anyone, men out there, in that first week, I'm on day 11 now. So important subject, important topics, guys, the state of my facial hair. But I'm glad you like it, Daniel. I'm not sure if it will stay yet or not, but thank you for your comment. Okay, will we receive this presentation deck? Thomas says, yes, absolutely, you'll get a copy. Oh, no, I don't think you get a copy of the slides. I could probably arrange it, but you'll get definitely a copy of the recording. Daniel said, took a good stop loss hunter trade in the ES today. Great stuff. Thank you, Mark. Good. Pleased to hear that, Daniel. And I bet that was because you were patient, you waited for your level, you were prepared, you didn't get sucked into any of the nonsense before that. You waited, you saw it, boom, you knew what you were looking for, you waited, bang, pull the trigger, and you didn't overstay your welcome. Thanks very much. Take the money, move on. Good for you. And Daniel's posted in there a Paul Tudor Jones quote. So hopefully that, I'm not clicking it as a link and it'll take me and probably close the webinar off, but hopefully that is the quote and it was close enough. Rowie, he's a regular on these webinars. Okay, I'd like to know your thought about scalping versus day trading. You said in the past you were scalping for a long time, but also day trading. I found myself confused which one I should focus on. When I try to get 90-30 trading the YM, risk reward ratio 3-to-1, it probably will happen less than 1.1 in 5 scalps. But you probably know to set a 10-tick stop in the Dow. I get pinged a lot, so I'm confused what to focus on. Any recommendations? Okay, well, listen, I would always recommend this, Rowie. Slow things down. Less is more, less is more, less is more. Just dial things back a bit. Look for one good trade a day. That's not how you're going to, you don't have to say that's how the trade I'm going to be, just trading once a day. No. But just dial things down and go, hey, let me take a week to relax, drop the shoulders a bit. Just say, okay, I'm going to take one good trade a day. What are the trades I like to take? I like to take this. I like to take that. And then once you've done a week where you traded once a day, then bring it up to maybe 3 times a day and 4. And you start to kind of, because at the moment, you might be in a situation where you've got so much going on that you're kind of, I don't know what to do. I'm trying to find this and this is working, that's not working. And then when you put it all in the pot, it doesn't work. But actually, when you split it out and you splinter it off into different segments of your trading business, you go, that actually does work. And the only way you find that very often is to peel everything back, discard everything and go, right, I've got a 30, 60, 90-day plan to move forward here. Next week, I'm just going to focus on this one thing, and then this thing, and then this thing. And then you find out what's working, what's not working, start to get your stop loss dialed in, all this type of stuff. And, I had a story where, I was trading Dow. Well, God, this was, I still do trade the Dow now, but the story goes very, very long time ago. God, I've not been trading that long. I'm trading 20 years, not 50 years. But I was trading the Dow, and I was trading this strategy, and it just wasn't working. Right? I was losing money. So, well, I was losing money. And early years, you're kind of confused and know what's going on and blah, blah, blah. And I looked at my statistics, I looked at my stops, and went, hey, if I just move the stop slightly, this thing's profitable. I was like, well, geez, let's just move the stop a little bit. Let's work on improving the entry later, but just move the stop, widen the stop. And it was literally, and the reason I think about this, and I say this story so much, is such a turning point in my trading journey of going, well, damn it, it's okay that you're just, because of the stop you're using and everything else, it's rubbish. But actually, a little tweak is making it more effective. That's why if you strip things back and you just have one thing you're doing, you can see that. It actually pops out at you when you're doing your reviews and stuff. All right, let's move on. Let's get some of these questions done, should I say. Fantastic webinar. Thank you, Gareth. Appreciate your feedback. Antonio says, what for you is a good risk reward ratio? Thank you for the webinar. Appreciate your feedback, Antonio. Depends on the strategy, right? If you're trading a high probability trade, or you believe a high probability trade, then you can have a one-to-one. I know that's a bit controversial and textbooks don't say that, but that's fine. If you've got a high hit rate and you're getting these little, especially the stop loss hunter, a high probability of it going your way, or at least getting that risk off the table, then fine. Now, if you're something a bit more structured, the high risk reward ratio is absolutely what I'd look for. If I was looking for a longer term trade that was going to play out over a couple of hours, I would want 2-to-1, 3-to-1. And honestly, sometimes you've got to have your mind open for looking for 5s and 10s to 1s. I know people are like, oh, that's crazy, but think about it. Think about it. This is what we're going to talk about actually in the final series of the webinar, is turning the scalp, where you've got that very, very short term risk, into a potential runner. And that's when you get obscene risk reward ratio trades. Now, of course, not going to happen all the time. Of course, you're going to get stopped out a lot, but you can afford to because the maths are working out. Okay, Jacob says, how long do you eyeball or backtest a new trade idea edge you spot before actually trade it, and when do you feel it's ready for full size? Ooh, what a lovely little question, Jacob. Thank you very much. Me, I'm a little bit gun-ho. I go in. If I see something, I think it's opportunity, I'll kind of study it a little bit. Maybe I'll go back and go, how am I going to work? Can I deploy it? And I just trade it. And at the end of the day, right, you got to think of this. What's the risk you've got? If you're risking X amount, your R unit or half an R unit, you may as well give it a go, because actually some of the very best runs you'll have in trading is when, Jacob, you say, hey, I think there's an edge there. I think I've seen something. We seem to flush at this same time of day, or we seem to do this, we seem to do that. I'm going to trade it tomorrow, or I'm going to trade it on Thursday, whatever it may be. And you trade it and it works. You trade it again, it works. Trade it again, it works. And not constantly worrying about, I've got to make sure this is soak tested and it's got to stand the best of test of time. Sometimes little edges sit there and work for a period of time, and they're there maybe a couple of weeks, and you can milk them and then you're done. So I'm a big fan of going in and kind of just getting stuck into stuff when I see something I think is an opportunity. Fayez says, which time frame institutional traders use most of the time to enter into the Forex market? They use a higher time frame. Fayez, they're looking for the big macro moves and stuff rather than the okay, let me just qualify that. If they're not short-term algorithmic traders, then they're probably looking at the higher time frames. Gus says, thank you, appreciate that, Gus. Does it work in crypto, Bitcoin, etc.? Jay says, yeah, absolutely. I think that in fact, it's probably quite effective in that. And I don't trade crypto, so I'm not going to say, oh, absolutely does, but I would explore it, Jay, because you do have that liquidity, you do have stop losses, you do have a lot of retail in these currencies as well, so you're going to get that time sensitivity. So explore it, have a little look, see. You need to get a good volume feed as well. You've got your volume, you've got your range, you've got all the stuff you need, price highs, price lows. It's probably pretty effective. Ricky, sorry, says, amazing class, thank you very much. When we receive access to code Amber Scalper after week 3, yes, Ricky, the reason I'm not being an idiot about this, the reason I want to wait until I give you guys access to that is that I want to show you the tool, because if you take it out of the box and just use it with the default settings, you're going to be like, it's all right, it's kind of paints these pretty things in. But if I want to show you exactly what it does, how to best use it, then you're going to get the best out of it. And it kind of this is all strategically placed so that you kind of understand what it's doing and why it's doing what it's doing, why it's looking for these different parameters, how you can adjust them, and how you kind of put it on your chart and stuff. So yeah, week 3, I'll give you that access to that. Emmanuel says, as a beginner, barely a month trading, please, what's your best resource or guide for learning trading? Ooh, learning trading. You know what, Emmanuel? There's loads of decent beginner content on things like YouTube. You know, Pepperstone's got some basic stuff on there to guide you. But really, you know, if I don't give advice as such, but if it was me, I would just trade on a demo for a bit and just write down my observations. Just get my pen and I just sit there and I just observe for a bit. I pick a market, observe, right, when it did a high, when it did a low, how much it moved, and just feel the market for a bit. Just feel it, right? You can learn from a textbook, you can learn from videos, and there's some great content out there, absolutely there is. But there's no substitute for sitting there and watching that damn thing move and trusting your observations, and then start to trade on a demo, start to build a strategy, and then when you're ready, deploy it and kind of move to live. All right. I'm going to skip through this a little bit quicker, guys. We are running over very slightly. Mark says, great as always. Use the outside bar on West Texas Intermediate, which is cruel. I made a fortune last week. A fortune. Mark, I love hearing that. Thank you very much. And that was from the daily email, actually, if I'm right, Mark, because I sent out the daily email. And in Technical Tuesdays, I really outlined the outside bar idea. And so I'm really pleased that you've taken advantage of that. Good. That's what I like to hear. Another question here. Looking forward to sessions 2 and 3. Good. Yeah, they're going to be great. Real juicy content I've got lined up for you. Quick one. What is daily supply and how does it affect price action at all? Daily supply, I'm not sure what you mean by that. You mean like a commodity-based thing? I'm not sure. Thomas White, thank you for the webinar. I appreciate your feedback. Okay, how can you know before the time-sensitive players come into the market? It's just those levels, Thomas, just going, hey, just think about you, right? You want to get out. Where would you put a stop loss? So just go through the lens of, hey, let me look at this market and see where would stop losses be triggered? That's where you're going to get that time sensitivity. Does MT4, MT5 show the live candles as shown in the stock exchange? Good question, Sergio. I don't know that answer. I think depends on the data feed you get. Probably. But it's good enough, right? It's good enough. I did that example to show you the difference, but you get a reasonable approximation. You can see the difference was quite dramatic on some of the volume stuff, but it's a reasonable approximation. It's not perfect, it's reasonable. Fada says, do I have a mechanical strategy where time and price agree that we can learn, please? Mechanical strategy, I'll often trade the opening range breakout trade. We talked about that in a webinar, actually. That's a good mechanical strategy to start with. But as far as a turnkey thing I can give you and say, oh, this is going to be great, no, but it's a good place to start. David says, I'm at work right now. I'm really thankful for your time and knowledge. Thank you, David. Appreciate that. I appreciate you tuning in at work. Probably start my journey in trading a few years because right now I'm working on discipline and learning 2 hours a day, making notes and backtesting. Good for you, David. Get your discipline dialed in, but don't procrastinate over starting. You know, definitely, you know, start sooner rather than later. Don't overthink the game. Never going to be perfect. Ducks are never going to be in a row. And at some point, you've got to get your feet wet and obviously be careful of risking real money until you're ready for it. But don't delay that opportunity. Rory says yes. I have my first 10k week watching all your YouTube videos and web videos. Brilliant, Mark. That's great to hear. Good for you, mate. Good for you. First 10k week. Next stop 100k week, please, for you. But good, very good milestone to hit, and it feels good, right? You go into the weekend thinking, all right, that's good. It's a good mark. This is your first one, so great, and you feel so confident going to the weekend. You feel good, so good for you, man. I like that. Daniel said, if you try stop loss hunter and it fails at level holds, how many times you try to get in? I'm going to talk about that next week, Daniel. Great question. How many bites of the cherry do you take? How many bites of that damn cherry? Because if you take too many, you kind of negate the edge. But great question. Question here, could you set a limit order under the stop loss target area and confirm with volume after the fact? Yes, you could, or wait for a 15-second. But yeah, you could. I prefer to be a little bit more aggressive with that and be a bit more proactive with the trigger. But you certainly could use a limit. But the trouble you have with this, man, is if you set a limit, it just drifts through. Especially a trend there, it's going to drift through, fill you. You've got to really be at the screen to feel that little move and little pause and all that type of stuff. We better download this video from somewhere because I missed the first hour. You'll get a recording. Hippolito, thanks, Mark. Can't wait to see other sessions. Hippolito is our ultimate short-term price action trader. You can see him actually in Traders Mastermind. Thanks very much, Mark. Thank you, Thomas. You got to run, no problem. Is swing trading more profitable than day trading? Dante said. Depends who's doing it. Peter is a very, very good swing trader. He's another trader in Traders Mastermind. He's an excellent swing trader, trades Forex. And that just suits him. I'm sure he's way more profitable in swing than he is day trading. But then you look at Hippolito, for example, a day trader. It's your personality. It's about finding your personality. Now, what I would say is swing trading fits a lot of people better because of the discipline issue and the time. If you're working, you have family commitments in swing trading. But if your personality is aggressive, you want to take those trades, you can kind of do stuff and then be flat at the end of the day, then day trading is a great way to do. I don't think there's one more profitable than the other. Some people they both can be very lucrative if you get them right. They both can be awful for you if you get them wrong. It's just finding what fits your personality, I think. Thank you, Peter, for that feedback. Thank you, Mark. Jay says, thank you for your answer. You're welcome, Jay. I'm gonna have to skip through these guys. Would you my apologies, understanding the learning program. Oh yes, it's always 6 o'clock UK. It might be, it depends where you're tuning in from, Raj, but it's always 6 o'clock UK. Well, not always, it has been so far. Who knows, it will change. But we're on British summertime now, so maybe that's changed things for you. What would give you nice risk reward stop loss? We'll talk about that, Rowie, in next thing, the risk reward ratio. Steve Cheshire, I don't know if you're surname or where you're from. If you're from there, you're not far from me. Great presentation as usual. Thank you very much. Currently trading 15-minute time frame with 3-hour return. No trades a week so far, but good. I like these boys. You traders got this, man. No trades this week so far, and you're happy to learn the patience. And exactly, and I bet when you saw that thing, it was like, listen, impatience is the road is littered with impatient traders, scalpers. When you're patient, you feel good. You got the end of the day and you feel good. So, yes, good for you. This strategy is also interesting to look at. Thank you. Looking forward to next week. Good. Do you still keep a journal after all these years? Absolutely, Gareth. And I am a diehard pen and paper guy. I do some stuff. I just can't get away from it. I like printing out my chart. I like marking out my chart. I like printing it off, sticking it in my notepad. As you might have seen, so every now and then I kind of stumble across a box that's just full of journals, and it's super interesting to read stuff. But I think, if you can journal on and put use some of the software, some great tools out there. I'm just conditioned, I suppose, to pen and paper. Love the daily emails. Thank you, Sebastian. I'm glad you like those. I love writing them as well. I absolutely recommend everyone sign up for those. It's free, of course. You can unsubscribe anytime if you think it's a load of old tosh. Thank you for the webinar. And some more thanks. Thank you, guys. Mark says, 3K from 5 contracts. Good for you, Mark. I really like that. Robert said, thank you very much. I'm going to have to skip through. Sorry, guys. Because Peter is doing his call to Traders Mastermind right now. Everyone's saying thank you and appreciate all your thanks. Okay, if I haven't got a question, if I didn't get to it, bring it next time. I'll try and be a little bit more on time with the presentation next time. See you next time, guys. You're already registered for this one. You will automatically be sent a reminder for next time. Check out the daily email if you fancy that. Otherwise, take care, keep your risk managed, and I'll see you in 1 week. Unless, of course, you remember, and I'll see you soon. Right.